cash is a risky asset. I think so many people think if I go to cash, I'm going to be safe because it's much less volatile. But please realize in this environment of producing a lot more cash, the real returns go down. It's a seductive asset because, let's say, relative to inflation, you might get taxed 7% a year. That's a huge amount of money over time, but it's a subtle tax. So first, watch that. Then, this is a study that I've been doing, and then I decided to share it with people because I think it's so important. A number of years ago, first with 2008, we got into a monetary situation, of course, where we're printing money, creating a lot of debt, and monetizing it. And that led me to realize that there are three big things that are going on in the world that are dominant. And then COVID came along. Those three forces are, first, the long-term debt and monetary cycle, which I mean creating a lot of debt, monetizing it, and the implications of that, which reverberate through the system in terms of all the markets. And the second is this conflict, this polarization, this wealth gap, and how we're at each other's throats. And I looked at the wealth gap, and I looked at a lot of measures of conflict going back in time, and I found that they were in the 1930 to 45 period. The printing of money, as I described, and debt monetization was also in the 1930 to 45 period. And the third big influence is the rise of China, so the rise of a great power, challenging an existing great power, the United States. And that has enormous implications. As an investor, I think, what are the relative appeals of the markets? It has a lot of implications. The trade war, so the markets and everything were reverberating the trade, the technology war, the geopolitical war in Taiwan and the South China Seas, and then also the capital war. We're seeing that emerge. So those three factors required me to then go back in history. I wanted to study the rises and declines of reserve currency empires. So I needed to go back far enough that I would have a few. So I had to go back 500 years to see the rise and decline of the Dutch Empire and its reserve currency, the rise and decline of the British Empire and its reserve currency, the rise and beginning of decline for the United States and its reserve currency. And it is really concerning, more concerning when I went back to find the 500 years and the times that repeated over and over again. And what I found was there's a cycle. There's a big, you start a new world order. In 1945, we began a world order. After the war, they decided how the world would be divided. They created the dollar as the world's reserve currency and so on. And then, because there's so much fighting, and then you've established a power that is a dominant power, you have a period of peace and prosperity. And then that gets extrapolated, and it leads to more debt. Fear of bad times diminishes. Opportunities of borrowing and getting in debt, particularly if you have a reserve currency, because the world wants to save in that reserve currency. And that gets the country deeper and deeper in debt. And so you have those debt increases and you have bubbles, but you have prosperity. And bubbles are really, really enjoyable. But then you get to the point that there is a limitation to that. And those limitations become apparent when the central bank can't easily produce money and credit. That starts when you hit zero interest rates, because then you can't do it the same. Monetary policy one is interest rate monetary policy. When that doesn't work anymore, you go to the next type of monetary policy, which is printing money and buying financial assets. But that purchases of financial assets and other widen the wealth gap, because those who have financial assets do better than those who don't have financial assets. And you have a wider and wider wealth gap. And when you have that wider wealth gap, and then you have another downturn in an economy, that's a formula for a lot of conflict. And so that's what we see. Central bank then do. If it taxes, it takes money out of the economy. That's not good. It's a problem. Mm-hmm. And if it cuts expenses, that's a problem. So the central bank always, through history, this goes back literally thousands of years, the central bank or the entity that controls money then prints more money. think of it, we got all those checks in the mail, and we needed to get all those checks in the mail. You can't take it away from anybody. Where does it come from, and what are the implications? So that happens for logical reasons. And it often happens at the same time as there's a rising power externally as a competitor, which is a challenge in that environment. So yes, it's one of those times. And I think people are not aware of it, because I learned from my experiences that many things that happened in my lifetime that surprised me never happened in my lifetime before, but they happened many times before in history. And that if I would go back in history, I could see that. The first time that happened was in 1971. I was clerking on the floor of the New York Stock Exchange, and Richard Nixon gets in front of the camera and says, "We're not going to give you the gold," and devalues the dollar. And I walked on the floor of the stock. I figured there was a big, and I walked on the floor of the stock exchange, and the stock market was up 4%, which was the most in a couple of decades. And I said, wow, that's surprising. And then I found out that Roosevelt did the exact same thing on March 5th, 1933. And what was done in those two times is the same thing that was done on April 9th when the federal government and the Federal Reserve decided to produce a lot more money. And so yes, you need these perspectives, and I want to pass that on. Monetary policy 3, which is now what we are seeing and what is needed, is the production of that debt through government borrowing and the government direction of those checks to those who need it most. That's what we just saw. And that being then monetized by the central banks. And so we're in a new era, of monetary policy 3, as I call it. Monetary policy 3 will mean that the free market will play a much less in determining those capital markets, that the government, as we come into the future, will be thinking, how do I get that money to those who need it the most? So it'll be a highly political decision, much more political than it was in the past, and that the central bank then will monetize those political decisions. So monetary policy 3 means there's that type of cooperation. So those are the two dimensions of the big change environment. You're going to see much more government influence and direction of where money goes, which will have a big impact on not only the economy, but of markets. You have to watch what they're going to spend their money on, and they have to watch where they're going to get their money from, what taxes and so on means. The government will play a bigger role. And it also means that there'll be much more debt that is monetized. And that has implications for the value of financial assets. It has implications for the value of the currencies and so on. When you get to the end of the arc, if money is hard, when it was connected to gold or it was gold, they always broke that link. And if it was soft, they would always print more money. And you can't raise living standards by printing more money. You can redistribute it. Certainly the money that is being received by those in the form of checks and they go out and spend it helps their living standards. But what it does is it diminishes the value of that cash, and it diminishes the value of bonds, because bonds are a promise to receive a lot of currency. And it shifts wealth to financial assets. It always sends stocks higher, like my 1971 lesson. It always sends gold higher. So when we're looking at this, we're going to also see, I think, the rise of the increased importance of China's renminbi as a currency. It's got a long way to go before it's going to be a reserve currency. But I think that one of the important things to see is that you're going to see favorable capital flows for China. And if you do a comparison of their market, where their interest rates are, where their capital markets, who's doing IPOs, nearly half of the IPOs, depending, we'll find out, but something like 45% of the IPOs, and there will be done in China's markets, Shanghai and Hong Kong this year, new offerings. And more you're going to see the internationalization of the renminbi. You're going to see capital flows move in those directions. And those kind of analogous movements have repeated through history. And so I believe when I look at that, and then if I narrow down to investing, those would be kind of the main headlines that I'd like to pass. It would be, first, to realize that cash is not a safe investment. It's a very risky investment. The second big thing is diversify well. And when I mean diversify well, I mean diversify globally, in countries, in markets, and in currencies. One of the things I learned really in 1971 and then repeatedly is that surprises that happen in my lifetime happened to me. Many cases were for things that didn't happen in my lifetime but happened in prior lifetimes, such as in 1971, I was clerking on the floor of the New York Stock Exchange. August 15th, Nixon severs the relationship between gold and the dollar, so essentially defaulting. And I walked on the stock exchange. I said financial crisis, and I would expect it to be down a lot. It was up a lot. I studied history and found that the exact same thing happened in March 5th, 1933, with Roosevelt doing the same thing basically on the radio. And then I understood things better. So what happened for me over the last number of years is there are three big things that are happening in my lifetime that didn't happen. And I actually found with research 5. So the first is the amount of debt creation and monetization of that and how it's carrying through the system. The second is the amount of internal political, social, economic conflict that is now going on. The third is the rising of a great power to challenge the existing world order and the existing world power, China, and the geopolitical, in which, when I was born in 1949, 4 years after the New World Order began in 45, and the United States, of course, was a much more dominant country then, had 80% of the world's gold, 50% of the world's economy, the monopoly on military power because of nuclear and all of that, and it's declined on a relative basis. And that led me to do research, which I needed to do the last 500 years of research to follow, to study the rise and decline of currencies, reserve currencies, and their empires. And I went back. And in doing that, I also discovered that their acts of nature actually had bigger effects than the first three of those, even with the wars, because of droughts, floods, and pandemics. And then number 5 was the greatest, of course, is man's capacity to adapt and invent, because in one way or another, if you look at that, per capita income rises, living standards rise over periods of time. But these big cycles and these big events are dominant. So those are, almost everything can fall into those 5 categories, so that's how I look at it. I think that we're in a period in which there's a supply and demand for debt and credit, because one man's debts are another man's assets. And that is making us move into a stagflation kind of environment. In other words, the trade-offs between the two will become more difficult. But I think that number 2 influence, the political, is the most important. I think we have been used to being in an environment in which economics ruled. You'd have a global economy, and those who could produce items more efficiently or cheaper would get the business, and they would raise their living standards, and other places. It was a global competition largely run by economic considerations, and resources would shift that way. I think we're now that doesn't exist as much that way. And there's been a transition to an ideological allocation of resources and so on, such as, the acquisition by Elon Musk of Twitter. It's not a financial transaction as much as it is for the purpose it'll have controls. And when we have the conflicts such as with Disney and DeSantis in Florida and those political ideologies, it's the belief that economics has got to fall within that agenda. That'll have very big implications, I think. And then, of course, this external. Looking at it year by year, this is the 3rd year of the expansion with a very aggressive monetary policy. So we're in the part of the typical expansion where there's a lot of inflation pressures because it happened in a giant big way. And everybody's long the world. It's the end of a paradigm because everybody believes that they want everything to go up. And of course, that creates a dynamic where policy is long, everything goes up. And of course, that happens by creating money and credit, and which creates debt. And that dynamic means that you must have a decline in real wealth measured by that, because that's the financial wealth has become enormous relative to the real wealth. Everybody who's holding bonds or assets, particularly the debt assets, believes, or financial assets in general, which are just journal entries, they're claims, but they believe that they can take that buying power and sell it and buy goods and services, and they can't. And by its necessity, there must be negative real returns, negative returns relative to buying power. So if we take it chronologically, I think there's the short-term cycle, which is usually the business cycle, takes 7 years on average, and the give or take, depending on where you start the cycle, give or take a few years here quicker. So we're now going to be in a very tight environment, and that changes everything. So when we look at the returns of equities and we look at the well-being of companies, you see that the cost of interest relative to the expected returns of equities creates a squeeze on equities, changes the economics. A lot of borrowing has been done at much lower interest rates and so on. The return on equity for a company versus the return, the cost of debt is changing, and all of those are changing. And like all bubbles or paradigm shifts, the mentality that did exist, we don't have to worry about inflation, cash is a safe place, and so on, gets a shock. There's a punch in the face. There's been a 40-year bull market, and there's a punch in the face to all investors. And when that happens, things that were never supposed to happen because everybody believes in the tech companies, which is the same as the Nifty 50 or the .com companies, they get hammered, right? 75% decline in Cathie Wood's funds and so on and so forth. That causes the adaptation. So we're in the beginning of that adaptation. That is most similar to the 1970s period. And it becomes financial. So I think as we will come to the 2022 elections, and that'll have economics and markets as a big impact. I think that you'll see greater political extremism coming out of that. Moderates are leaving, and even those who are running are populists. Populists are people who will fight to win and will not accept losing and will fight for their constituency. So you'll see more populism of the left and more populism of the right. So if I look at 2024, and I'm worried about the neither side accepting losing. And I think that there's a big risk that the system is in jeopardy, because history has shown when the causes that people are behind are greater importance to them than the system is in jeopardy. Those types of things change the world landscape. I'm emphasizing the United States, and certainly Europe is in that type of a position. So I think that when I look at it, it'll be very important to not only diversify well, but to be able to be long and short different assets in order to perform well in that environment. My main things are, first, cash is trash, and that there's in bonds and debt, it's not going to be good. And the claims of financial assets. So either avoid those or position yourselves so that when those things operate, and position yourself for inflation. So there are lots of investments pertaining to inflation. And the big commodity cycles are reactive. There's a giant, just like the 40-year bull market in bonds, associates with a commodity cycle where everybody adapts to that. Companies don't hedge. Inventories are drawn down. There's less investment in those things when that switches to that kind of an environment. And the big overarching thing is that the amount of financial claims that exist, there's charts that I repeatedly show when I deal with the changing world order. What is the amount of financial claims, assets, relative to real assets? And you could see that through history, when those financial claims, it's like a bank has too many IOUs on its real money and that thing, then you always get into these environments where it's undesirable to own the debt and you have negative real returns. And so to position one's portfolio in a tilt that way. Of course, the way that we do it is to separate alpha and beta, right? So two parts, core, because we're all talking tactical. How do you create a truly well-balanced core portfolio? And we know that the typical well portfolio is not well balanced, with its greatest vulnerability being in that upper right quadrant in our box, which is the inflation box. And we know that we're in that environment. So from a starting point of view, I would encourage all investors to look at those 4 quadrant box, that box that we have: rising inflation, falling inflation, rising real growth relative to discounted, falling real growth relative to discounted, and see what the biases are in those portfolios. I believe that now you can simultaneously reduce risk and raise returns, reduce risk of that portfolio by having more in that upper right quadrant, rising inflation, and you will reduce your risk, because if you look at your portfolio, typical investor's portfolio, that is the environment that it is missing. So you start with that. How do you get more neutral? How do you get better balanced? And you cover yourself from that exposure. And then you make your tactical moves around it. And the tactical moves, again, should not be in those debts. It should be very well diversified. I think that the social and political conflicts are going to be a big investment thing coming forward. And so that'll mean, the way I look at it is, I want to look at places that have good income statements and balance sheets. So when I say places, I mean countries, as well as individuals that make up those countries, the individual people and the individual companies. So do they have a good income statement, financial stability? Do they have a good balance sheet so that they can weather those things? And also, it's a sign of their productivity. Are they productive? And then number 2, are they civil with each other? I really do believe that internal conflict and bad finances are going to be defining characteristics of where to invest or even where to be. And then if I carry that forward to the third, am I going to have in risk of being in an international war, an important international war? Because that international war will raise lots of threats. So I want, when I'm picking those locations, I want to be the inflation hedge assets, well diversified, look to parts of the world that are not as plagued with this. So emerging Asia is very interesting. India is interesting. Look at neutral countries during that period of time. Watch out for government controls on capital markets, because that's the logical next step. History has shown that. Watch out for foreign exchange controls, could be. Watch out for those things. So those are the themes that I think are most important and will be most important in investing. There are 2 purposes of a currency, which is a medium of exchange and a storehold of wealth. And we're living in a world where we have the 3 major currencies are fiat currencies with the same kind of problems. So you can't look at one currency in relationship to another. I think people make a lot of mistakes of thinking, it's an ugly contest. The questions that we're going to be in is storehold of wealth. What is your storehold of wealth? And a money is a storehold of wealth that also is widely accepted in other countries so that you can move it around. It's not just limited to currencies. Don't think that medium of exchange is the only important thing. So think about the store of wealth. That's when we deal with the quadrant, the 4 pieces to try to find a balanced storehold of wealth. And then you have to think, can I move that and sell that anywhere? Am I going to have the free capital markets to do that, or are they going to be a problem? And I think we are entering a period where all currencies, the traditional medium of exchange type of currencies, are going to, a lot of currencies will compete. What will be the medium in which I could take something and go someplace else and cost effectively convert that into buying? Okay, the medium of exchange. I think we're in a storehold of wealth issue. In other words, focus in on that. And then, your transaction cost of converting that storehold of wealth, a balanced portfolio, into buying power. And then you transact, because even in the worst inflations, the worst environments, the currencies, most of the time, still could be mediums of exchange, even though they're devalued. So I encourage people to think about bad fiat currencies generally and what the liquidity is, and think about even what capital wars look like. Gold as a overlay on a portfolio, on top of a portfolio, works like an insurance policy. Gold is a dead asset. It just sits there, but it's always through characteristics that are limited in supply. One of the most important things, it's the third highest reserve currency held by central banks. And in periods of time of war, or such periods of time of credibility, it is the medium, like they say, it's the only asset that you can have that's not somebody else's liability. That means you have to be dependent on them giving you money, or they're giving you something. And it is international, it can be moved, and it's tried and true in that regard. But its behavior is very environmentally specific. So as a hedge asset, it's really like a great insurance policy, because when the other assets go down. And so something like that, or the equivalent, plays a role in a portfolio, not as the core asset, but as the effect of diversification of asset. If you do it as an overlay, it's about 15% of the portfolio, not taking away assets from other parts of the portfolio. Back to my basics, which is the 4 quadrants, the timeless and universal. The one thing that you can be sure of is that cash will not be the best asset class. And when you diversify a portfolio, so you got a well-balanced portfolio of other things, it will outperform cash, because it's the nature of the system. People, the central bank puts money on deposit, people with better ideas come along, take elements of risk, and it works. It works better than the traditional portfolio in the down moves by a lot. Like when the market goes down 60% or so, the worst cases are like 20%, maybe a little bit over than that. And it never stays there, because central banks can't let capitalism, which is dependent on those other assets performing a higher return than cash, can't let that continue. So they come in there and they produce money and credit, and it produces the pop. You find in studying history is that depressions are mostly debt and liquidity crises that are dealt with one way or another through easing of monetary policy, which changes over a period of time. I described monetary policy 1, interest rates. Monetary policy 2, buy financial assets, print money and buy financial assets. Monetary policy 3, which we are in, is the printing of a lot of financial assets by the central bank, and then buying government bonds to finance the deficit and getting money in the hands of those who wouldn't have had it through the normal financial system, essentially through that coordination. In all history, so when we go back to the 1800s and so on, there is that. And so the alleviation will happen in terms of that kind of ease. So when we think interest rates are going to hit 0 and that therefore depressions last, no, they don't last, because in one form or another, and we're seeing it here today, that they will be the printing of money. Now, the value of money may not last, or they can be depreciated, but in the end, they always will ease, and you will have then that kind of reflation movement and that kind of change. So the hitting of a 0 interest rate is not a hitting of a floor on the capacity of central banks to ease. If you look at the history, you've seen it happen time and time again in the same way, and it lends itself to 3 types of assets responding. The it that's happened in March 5th, 1933. Roosevelt makes the announcement about severing the dollar from gold and depreciating it and reflating it to give the banks the money that they have to pay to their depositors. The same thing happened August 15th, 1971, when Nixon got on television and said that he is severing the relationship with gold and printing money and so on. The same thing happened in November 2012 with Mario Draghi making the same kind of moves. And the same thing happened on April 9th when we had the moves by the U.S. Federal Reserve and the U.S. Congress and Treasury. Same type of movements happened in 2008 when the Treasury put together and the administration and the Congress put together the TAR program and they went to quantitative easing. Those are the things that you always see happening, including times that I haven't mentioned. And when they happen, that is what happens at the equivalent of zero interest rates. Okay. It is that kind of movement and that form of easing. And that's what we're seeing. And so easing doesn't end, and the liquidity squeeze and the debt squeeze is dealt with, but it's dealt with through the printing of money that could become manifest in either the real interest rates going down, which in the case of with you have a low level of inflation and zero interest rate must be manifest with an inflation rate rising, which eventually happens, doesn't usually happen at first, or there's the depreciation in relationship to other assets. So what you're seeing right now is that reflation becoming manifest in the money that is being purchased by the Federal Reserve and government, then going into assets that are equity assets, into credit assets, and so on. And that's the manifestation. Or you could see it in gold, or you could see it in the depreciation. One doesn't necessarily know at the time which is going to happen. So in 1971, when that happened, there was a big decline in real stock prices because inflation accelerated. But you do know that that combination of reflation assets will happen in a way that's very similar to the cutting of interest rates when they hit zero. I really believe that in this environment, most investors will think safe is cash, and that's tragic. So you can see that one has to think differently from one's habits. When one thinks cash is not a safe investment, it's a risky investment, that stocks and bonds are not the same as they were in the past. One has to think of the storehold of wealth concept rather than just equity returns. One has to think about balancing differently. All of these things that I'm bringing up are not commonly thought about. They're not part of the common experience of investing over the past many years. In order to understand the lessons of history and even what's more likely to take place, one has got to go back to periods that were analogous to this and to study those periods. And when we did that over the last 500 years, you could see that you don't know if you're going to see the depreciation of the value of money and the storehold of wealth. So all of a sudden that changes what you define as risk. You used to think cash as a riskless asset. Cash can be the most risky asset as it depreciates in value. And then you start to think about different asset classes and different locations. So that's what we're doing. When we think of what is the diversified portfolio for an easing that happens at that time, that's kind of a reflation portfolio. And how do you measure that in relationship to other things? Because I think the one thing that we could be confident is that the Federal Reserve and other central banks are not going to let an implosion happen without printing a lot of money. We know where interest rates are. You know that if you take a 10-year bond, you know what your return is going to be on that 10-year bond. And if you then do calculations of what is the expected returns of other asset classes, that all asset classes, and that includes private equity, it includes venture capital and so on, have very low expected returns, meaning that if you were to just hold them over the next 10 years, they're all going to have not nearly enough return, and they're going to be low. So that's a fact of life. We also know that asset classes are affected by monetary policy. So when they lowered the interest rates and did a number of other things in the past, that allowed asset prices to rise. We know a number of those things won't be able to happen in the future. But that is the character of the environment. So that the environment, it's a reality, right? Does anybody disagree that the returns of asset classes will be low from just an expected return point of view, and that monetary policy and which is now buy financial assets and so on and print money, will be a lever that's going to have an effect on that. And so we're going to get volatility, and we have a high amount of uncertainty in that environment. So that has implications. Can we agree on that we're going to have low returns, inadequate returns generally relative to needs, with a lot of volatility around them? Can we agree that's a fact of life? I think it is. And then the question is, how do you approach it from an investment point of view? Let me describe it this way. Achieving balance, which means diversification, is more important than ever, though it will have a lower return than before. So do you want an asset class return, or do you want a portfolio of well-balanced assets? So when I look at that, I'm saying, let's say if you take a 60-40 stock bond mix, or if you take equities, or you take any one of those things. No. I think the most important thing is to start with diversifying well. Diversification of asset classes, diversification of countries, diversification of currencies, diversification, because I think that the one thing we know is that we don't know a lot, and it's not easy to necessarily time it about what is going to happen, right? So we should be given humility, and because the markets are relatively efficient in making those comparisons, it's not like one thing is necessarily better than the other, as much as we do know that some things are better diversifiers than other things to produce whatever that excess return is, that it is as stable as possible and least risky as possible to try to achieve balance. So as we look forward, what we can say is the excess returns will be lower, the premiums are a bit lower, but it still is better to have that diversified portfolio. It'll be a lower excess return, but it still means more stable, because the individual items that make up will all have low returns, but the combination of them will make it more stable. The concentration in any one asset class, in any one country, in any one anything, history has shown is dangerous, and it is dangerous now. So when I look at it, for example, what we're seeing is reflation. We're seeing the central banks printing money and buying assets. And I do believe that they're going to continue to do that. Then the question is, does that become manifest in a way where it drives stock prices up? Does it drive the value of money down? Does it drive gold prices up? In any case, I think the big thing is that almost no investors has enough money relative to their needs. It may affect the time horizon, but if you looked at the richest investors, generally speaking, and you looked at what are their revenues, what are their expenses, and what is their saving, every individual, every company, every country has to go through that exercise. And when you look at that exercise, can you spend on your liabilities or pay out that amount of money based on the income that's coming in, or the way you're going to have to tap that savings pool? You can see all around you those that are going to not be able to make it, not be able to come close in the period that we have. You have to think, what does that mean? That is going to mean that those will not default. You cannot tell most of the people that they won't get their money. That is going to mean that a lot of money is going to have to be printed, because the obligation is to print that amount of money to fill those liabilities. And so that's the situation that we and most of the world are in. So when I think of investing, I want to invest in the competitive countries. I want a multi-country investment. I want a multi-asset investment. I want a multi-currency investment, and I want a storehold of wealth, because what happens is wealth is not so much destroyed as shifted, from one asset class to another. There's competition of asset classes, competition of countries, competition of currencies, and so on, and they move around. And so they have to start off diversifying well. And then they go to where are the alpha sources and how does one create a well-diversified mix of alpha sources. So it's the same old story.